Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves review for Friday, 28th of May. My name is Carl Capilingua. I'm the market analyst over here at Think Markets Australia, and it is a pleasure to be with you as we recap all the big moves from the brokers for the last week, all the upgrades, downgrades, price target changes, and more. And we'll do that after we talk about the Think Markets difference, which is substantial, $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. Four fantastic reasons why your next ASX share trade should be with Think Markets. But I can give you 5 more if you are new to the Think Markets family and you sign up and get trading before June 30. Your first 5 trades are on us. There are some terms and conditions, so head to the website for more details. As suggested, the agenda for today is to check out all the big broker moves and 3 ASX stocks of interest. Let's kick off with the ratings upgrades first. Now, each broker has a rating system for each of the stocks they cover based roughly around buy, hold and sell, and also a price target system based upon their valuation of the company. It's pretty much where they think the share price could get to over the next 12 to 18 months. Looking at the first item on the list, we've got Costa Group Holdings, which is the agricultural products company. They have seen their rating at Credit Suisse go from neutral to outperform. That's a step in the right direction. And their price target actually reduced from 470 to 415. Now that is an 11.7% reduction in the price target, but based upon the current price for Costa Group and that price target, the broker is seeing about 23.7% of upside. And there was some news on Costa Group during the week. The company held their AGM and provided some profit guidance for the first half, noting that it would be slightly ahead of the same period in 2020. Share price fell rather sharply on the news, however, because markets were expecting more. Credit Suisse in particular said that the new guidance missed consensus estimates, but looking on the bright side, Credit Suisse said that the reasons for the miss are likely more to do with non-recurring setbacks like labour shortages, particularly in their mushroom growing division, rather than long-term structural issues. There is going to be some earnings volatility and pricing instability ahead. So the broker did lower their FY21 estimates by about 7%, and the ratings change was more to do with the fact that the share price fell quite a lot, and therefore it would be more likely to outperform from its lower price base as a result. Looking at the next one, Champion Iron from Citigroup, they upgraded from sell to neutral, so only to roughly a hold, but there was a massive price target increase from Citigroup from 530 to 710, and that still allows about 7.6% worth of upside. Champion Iron reported their full year results during the week. They saw a 63% increase in revenues, as the name suggests, an iron ore producer, and therefore has been riding those higher prices. Profits were up 419% to 495 million Australian. Citigroup said that that final quarter production and full year results were very, very strong, obviously on the back of the higher iron ore prices. Top line profit numbers were a miss, however, but the outlook remains solid enough for that earnings upgrade. Macquarie on travel management, they tweaked their rating from neutral to outperform. Their price target up just 3.5%, but company fairly fully valued, which is interesting because we normally don't see an outperform when the price target leaves so little in it. Macquarie did note that some of the other travel companies out there are reporting improvements in their underlying businesses. Corporate travel in particular is seeing an uptick in its Australasian and US operations as we, fingers crossed, near the end of this pandemic. Citigroup commenting on Domino's Pizza there, they went from sell to neutral, a big increase in the price target, but that's really more catch up to me, and you can see that evidence in the fact that even with that huge increase in the price target, Citigroup thinking that Domino's is fairly fully valued here. They did say that the upgrade was based upon the company's European growth prospects, saying that the pace of store rollouts is improving as the company aims to open 2,850 stores over the next 7 to 12 years. Morgan Stanley on Mervat going from equal weight to overweight, a nice pop in the price target there and a little bit left in it. That's encouraging from Morgan Stanley. The broker noting that house prices are rising across the country and Mervat should be a beneficiary of that, and in addition, Mervat's developments, which include obviously many apartments and residential developments, seem to be better priced or more competitively priced in the marketplace, and that's a big bonus. Citigroup on New Hope Corporation going from neutral to buy. A company is also by a nice pop in the share price from 155 to 175. That's a 13% increase, and still plenty of upside seen in it. Citigroup upgrading their thermal coal price assumptions on the back of a recent rally in prices. That resulted in a material earnings upgrade for New Hope, but Citigroup noting that the market is not exactly enamoured with coal stocks at the moment. That might explain some of the really cheap valuations in the sector. New Hope in particular trading at just 3 times enterprise value to EBITDA for FY22. Citigroup also noting the strengthening in New Hope's balance sheet. Citigroup on Oz Minerals going from neutral to buy. Broker maintaining a $27 price target, which leaves fairly limited upside at 5.6%, but some fairly bullish comments there. Citigroup, but whilst respecting the fact that copper prices have pulled back, which potentially will undermine the company's short-term price performance, they do expect copper prices to rise as much as 20% over the next 6 months, which means that Oz Minerals is looking quite cheap after its recent pullback. And then JP Morgan on ResMed going from hold to accumulate. Price target up 7.5%, which leaves about 7% upside from the current price to that target. JP Morgan reviewed their earnings forecast for the company. They said they saw extra potential from the recent launch of the company's AirSense 11 flow generator platform. They are expecting better margins on the product down the track, which should help the company beat earnings estimates. They did say, however, there may be a short-term slump or a stagnation because patients, knowing that this new product is out there, are potentially going to wait until it's released before they upgrade. Talking about upgrades, they are all done. These are the downgrades on screen now. Aristocrat Leisure, they flagged their earnings results last week, released them this week, and whilst they were pretty close to what was specified, brokers did actually come out and have a fair bit to say on them again. Aristocrat Leisure was our feature stock last week, so I chose not to do it again this week in favour of looking at a few other ones. But we do have Morgan Stanley going from overweight down to equal weight here, but increasing the price tag on the fact that those results were very impressive. But the company is just fully valued at this point in time, according to Morgan Stanley. Also reporting their results this week was ALS, ticker code ALQ, very confusing. Morgan Stanley going from overweight to equal weight here with a nice pop in the price target, up 20%, but that only leaves about 6% to the target price. The company reported a 25% increase in earnings before interest, tax, and depreciation and amortization, and that was on the back of a 5% drop in revenues. The dividend more than doubled to 14.6%. Morgan Stanley said they were impressed with those results, but they were concerned about rising cost pressures. They did upgrade their earnings estimates for the next 2 financial years on the back of an otherwise robust operational performance, but they noted these earnings upgrades would have been even higher if not for the expected drag on costs. Fisher and Paykel Healthcare also results out during the week. Credit Suisse downgrading from outperform to neutral, a substantial decrease in the price target there by 11.8%. And this was on the back of what appeared to be a really solid result for the company, 56% increase in revenue, an 82% increase in profits. But the company reported really slow growth on its home care products, only 2%. A lot of that headline profit was due to COVID and an influx of business because of COVID, and the company had a really uncertain outlook statement saying that, quoting here, there is a wide range of scenarios for both the timing and return to normal, and to what extent that return to normal might even look like. Brokers disappointed generally in the company, and it is one of our feature stocks, so we'll check out some of those other comments as we get along. Credit Suisse on New Hope Corporation going from outperform to neutral, retaining the price target there, and they think the company is overvalued. That obviously contrasts the upgrade on Citigroup. There was a bit of a timing difference there. Credit Suisse commented on some disappointing quarterly results, and as we heard before, Citigroup was talking more about the recent increase in thermal coal prices. Looking at the price target increases here, so no change in the ratings. Aristocrat Leisure As we said, a great set of results, but largely pre-released to the markets. Still, we did see a run there of price target increases, 5 out of 5, fairly modest ones. But as you can see, the company appears to be fairly fully valued in the eyes of the brokers. Nonetheless, with a buy, an outperform, an accumulate, and a buy, they're clearly still very positive towards the stock. We've talked about ALQ's profit results as well. Some big price target increases there, but most of them catch up. However, still some reasonable upside seen at Credit Suisse and Macquarie, with outperform, and the rest are fairly neutral. Looking down the list, pretty quiet here until we get to CIA. We've talked about the massive result that they had earlier on, and also Citi's upgrade of the company, and we also talked about Domino's as well. Let's just focus on the bigger ones here. In fact, we've done Mervat, haven't we? We've done New Hope as well. A nice pop there in New Farm from Citi Group, retaining a buy, and still plenty of upside seen in that one. And then SG Fleet, a nice pop in the target price there, 16.7% and still 16% upside, and an overweight rating from Morgan Stanley. Not so lucky. On to the next page, the price target decreases. Costa Group Holdings on the back of their disappointing earnings outlook. Labour shortages, lower prices for avocados, that was also in the announcement. Fisher and Paykel, we talked about their disappointing outlook. And then there's a pretty big drop here on Salt Lake Potash from Macquarie, down 18.8%, but still seeing plenty of upside there and an outperform. Now, Macquarie cited rising costs and the degree of the discount on the recent capital raising for reasons for that price target change. And then Zipco from UBS dropping their target price by 17%, and despite that fall in the target price, they still think it's about 22% overvalued and have retained a sell rating. UBS noting lower margins from their US operations as competition increases, and locally also the CommBank launch of their buy now, pay later platform, making things a little bit harder for Zipco. Heading into the three focus stocks we have today, kick off with ALS. We heard earlier on that they released a very solid set of results. This is a testing company. They do the testing for mining companies, so assay results. They also do assurance testing for the food and drug industries as well. And we know particularly the mining sector doing quite well at the moment on rising commodity prices, so plenty of activity there. Looking at the chart, plenty of activity on the chart as well, and it's heading in the right direction. We do have a short-term uptrend in place, as evidenced by the light green zone there, and a nice long-term uptrend in place. We have broken above all-time highs, very impressive. Always a very strong sign for a company when they're making new highs. It means demand is effectively the best it's ever been and supply is very restricted. Why is demand so high, Bill? Because investors do their analysis and they like what this company's doing and what they're expected to do. Why is supply so low? Well, the same conclusions are being drawn, but this time by people who own the stock and they don't want to sell. Certainly a big tick for me on the technical side of things. Looking at what the brokers are saying about it, we've got an average of a buy with 2 strong buys, 6 buys, 4 holds. It's encouraging to see no sells or stronger sells. Mean price target of 12.46, which provides some upside there. But note, my data provider here usually takes a few days to update any changes, so we could see that increase further as some of these price target increases, say 13.45 there from Credit Suisse. 11.40 is a little bit on the bearish side there from JP Morgan. 13.50 is nice from Macquarie. 12.90 from Morgan Stanley, and 12.25. At least 3 of those higher than that average. Looking at some of the fundamental numbers here, enterprise value to revenue is about market average, or I guess the lower end of market average, and lower is better for that particular data point. Price to earnings ratio, you wouldn't exactly say it was particularly cheap, and based upon the broker estimates there, the growth is probably not enough to bring that down substantially to where we'd like it, which is ideally sort of that 15 to 20 zone. Dividend yield is very respectable, as is price to free cash flow, and the return on equity not too bad either. Look, it's a very solid B from me there. I'll give that a tick and I'll give that a tick, so 3 ticks from me. The brokers, Credit Suisse are going outperform and outperform at Macquarie are the 2 best. Don't forget we did have that downgrade from overweight to equal weight from Morgan Stanley, and the others are holds or neutrals. I'll let you press pause and read the commentary there, but the gist of it is that the commodities division is doing very, very well indeed and expected to continue to do so and drive earnings growth going forward. Having a look at the next one, not so lucky, unfortunately, Costa Group. We talked about their updated earnings guidance for the first half of this financial year. A number of problems at the moment in terms of getting enough labour to pick a lot of their produce, and we know there's considerable movement restrictions at the moment due to COVID, and that's generally how they're getting their labour, from other countries to come in and seasonally pick for them. We also heard of some pressure on avocado prices because there's quite a bit of supply around at the moment. And putting all of that together, a big drop on the chart, which, to be fair, the short-term trend was already heading down, but the long-term trend was very much intact. And in fact, we just bounced off that long-term trend. So unfortunately, charts can't tell the future. They're really only giving an idea of where the demand and supply is at the moment and where it has been in the past, and a little bit unexpected, I must admit, from the technical side of things, but that can happen. That's markets. And I think the brokers were largely caught unawares by this announcement as well, because we did have an average of a buy with 2 strong buys, 4 buys and 5 holds. No sells or no strong sells heading into that announcement. We had a mean price target of 466, which will no doubt come down now because we're going to 375 from Citigroup and down to 415 from 470 at Credit Suisse. Looking at the fundamentals, they look pretty good here. Enterprise value to revenue is very, very good at 1.43 times. Price to earnings ratio, you wouldn't exactly say this was all that expensive, and with a very strong PEG, typically we want to see that value less than 1, there is substantial growth in earnings within the business. The dividend yield is very attractive there at 3.45%, and the return on equity also quite good as well. Pretty exciting their current announcement, which is solid in the fact that they're still expecting to beat the previous corresponding period, but disappointing in the fact that the market was expecting more growth in there. The fundamentals, you'd have to give it a very solid B+ here. That's a tick, but unfortunately that's a cross. So fundamentals are a check based upon what we can see. The brokers are a check, but with the breaking of that long-term trend, can't exactly tell you to run out and buy it here. I'll let you press pause and read the comments heading into the final stock, which is Fisher & Paykel Healthcare. Another drop on their announcement. Don't forget they released their full year results. Largely impacted by COVID in a good way, in that obviously respirator sales and hospital consumables were up, but in a negative way in terms of a number of their other products just aren't getting a lot of traction at the moment, again because of this focus on COVID by hospitals and medical professionals. It's understandable, and they had that pretty uncertain outlook statement. It's probably a little bit at odds with what the brokers were expecting, because they were 3 buys, 2 holds, no sells, no strong sells. The chart is starting to waver in terms of its trend, isn't it? We've gone into what I call the equilibrium phase here, where demand equals supply, and that is after we were in quite a nice demand side market here, where demand is greater than supply. And the risk is, if we sort of break through this level here around about that $26 mark, we could be moving into a supply side market where supply is greater than the demand, and you could see something like this. All is not lost just yet. In theory, we're just hanging on to that long-term uptrend, but it's certainly on watch for me. So I can't go tick here. That's not so bad. In terms of the fundamentals, that's way too high, as is the PE. The PEG is shot to pieces. Dividend yield, not great, not terrible, but certainly nothing to get too excited about. Return on equity is the key here. That's been the big tick, I think, for the brokers and why they've been able to justify these valuations. I think this is the biggest vulnerability going forward. The PE is too high, and we've seen a lot of these high PE stocks come down more recently. So it would be a cross for me on that one. Again, I'll let you press pause and read the commentary there. Brokers, you can see, growing increasingly concerned about the company's outlook. Okay, that's it for me today. You can catch all of our other market updates in our market news section of the website. You can follow me or the Think Markets handles on Twitter. We do have some upcoming events. You'll need to head to the webinars section of the website to register for these on Tuesday, upcoming. We'll have a really good technical analysis webinar on how to use price action to spot trading signals. A week later, we'll have Ask the Experts, where you get to bring your portfolio to the table, and then you can register for the top 3 ASX mining stocks for the week after that as well. The disclaimer before I leave you says that everything we've discussed today is general in nature. We are also a regulated Australian broker, and we do have some products that could see you lose more than your deposit. So please read this disclaimer carefully, or if you have any questions at all, give us a call. That's it for me today. All the best for your trading until we catch up again. Bye-bye for now.